Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in. Hello, and welcome back to another episode of the AAA Storage Podcast. I have with me, as always, Paul Bennett. Paul, thank you for joining. Today is going to be an exciting show because we are going to be talking about the 2026 market outlook. So here are some trends, some themes we're seeing backed by data. We did a lot of this research in Q3 2025, updated it very recently here, and now are looking ahead into 2026 because we are currently in the first week of December 2025, and there are a lot of themes and trends developing that we're looking ahead into next year. And so we want to catch you guys up on that and also demonstrate some data that we've got. But if you want the full report, there is a full report on the 2026 market outlook that we have on the website at AAAstorageinvestments.com/insights. So please go there, download that report, and get the latest there. But I have my notes in front of me. Paul, you have put together a lot of data here. So I'm not going to go off the cuff, and we're just going to go down the line on these notes. So I don't want to get too far afield. So Paul, tell us a little bit about some key themes that you're seeing this year in 2025 and how those are extending into next year and how that might impact real estate.
Brandon, first of all, I hope everybody had a good Thanksgiving. I hope you had a good Thanksgiving.
That's right.
It's nice to have a little break.
Yes, amen.
But I think we start with the macro picture, the context that everything sits in, which is principally 3 or 4 major pieces of data. There's some other related data, jobs reports and that type of thing. But essentially, what we've done as we plan for 2026 is look at some of the smartest economists and guys out there and tried to come up with a consensus opinion. There are some pretty, not wildly different, but there's some pretty different opinions about what 2026 is going to be like. And if you kind of throw out the extreme on either end and pull the data together in the middle, you get a picture that is a reasonable expectation for 2026. And one of the things that everybody talks about is interest rates. And we do think that we're going to see probably potentially one more rate cut this year, and as many as 3, more likely 2 rate cuts in the first part of next year, although there could be some things that happen to cause them to slide a little later in the year. Interest rates are a key, particularly in commercial real estate, and they affect storage really not more than, but as much as any other part of the real estate world. And that's because when people think about interest rates, the average person probably thinks that interest rate cuts mean mortgage rate cuts, and that's not really the truth. Mortgage rates are tied to the 10-year treasuries, and not the Fed funds rate, which is when the Federal Reserve comes out and drops, rates up 25 basis points. That's the rate at which the Federal Reserve loans money to banks. It's the bank's cost of funds. Mm-hmm. So what we pay is construction interest, or the amount, the rates that we pay is directly tied to the Fed's funds rate. The mortgage rates are directly tied to the 10-year treasuries, which is a whole different animal. So we do think we're going to see rates at the Fed funds level decline probably as much as a full point by the end of 2026. They've come down a full point during 2025, but probably another 3/4 of a point to a point decline in our borrowing cost by the end of 2026, which means for us, variable rates make a lot of sense because we can ride the rate curve down if we get those drops. However, on the mortgage side, I think rates are going to stay basically in the area they're in. Right now, mortgage rates are in the 6.4, 6.3% range. I think rates by mid-2026 will be in the 5.8 to 6.2% range. And that's based on reading what the economists at Chase have to say, at Wells Fargo have to say, a number of different people. And it's really because 2026 is going to be a year of tug of war in the economy. There's going to be constant questions whether we're going to be facing inflation or recession. And that's going to keep the 10-year Treasury about where it is, and that's what mortgage rates are tied to. So I think you're going to see a drop in general interest rates commercially, and mortgage rates decline slightly, but basically stay in the range that they are. And the reason mortgage rates impact self-storage in particular is because moving is about 25% of the demand in the self-storage market. And we've seen a lot of that demand go away or be delayed in the last couple of years when rates have been higher and people, houses aren't as affordable as they once were.
Yeah.
Because of interest rates. And so it's going to have, although our borrowing costs will come down, I would love to see mortgage rates come down because that will spur some demand on the self-storage side. But I don't think we're going to see that dynamic happen in 2026, maybe late in the year. But anyway, so that's the rates impact both on borrowing cost and on new home sales is probably the thing that we watch as much as anybody else. The other things that we look at are the GDP forecast, which looks like the growth in the economy for 2026 will be somewhere in the 1.8 to 2.4% range. So middle of that range is about 2%, which is a solid growth, not expansive, but solid. And a lot of what I'm reading is saying that there are some expectations that inflation will tick up in the first half of the year and then really calm down as we go into the back half of 2026. And, all those things directly or indirectly affect businesses in our small bay, in our small bay product. And they directly or indirectly affect interest rates, which then affects everything. So those are the things that we really look at. And we're looking at relatively modest growth, controlled inflation, maybe above the Fed target at 2% in the first half of the year and at that target or slightly below in the second half of the year. And then rates, again, as I've already said, we think the Fed funds rate is going to come down 50 to 100 basis points. I think mortgage rates are going to stay fairly close to where they are. They may see sub 6, but it'll be the high fives, 5.8, 5.9%, not under, not significantly under 6%. So that's sort of the economic context that drives our expectations along with an understanding of where the market is and what's happening in the market, which we're going to talk about in a few minutes. So.
Yeah. No, that's helpful. There's a lot of, if anybody's following the financial news, financial press, there's always confusing information, conflicting information. And so you distilling it down to these key points is really helpful. I'm curious if you think how maybe the employment situation, labor force, or the consumer confidence levels, do you look at that or think about that? Like if you're reading the Wall Street Journal in the morning and, people talk about that, because that is the dual mandate of the Fed is thinking about the stable prices and full employment and thinking about that employment picture. Like how does that factor into your thinking?
There's a wild card that everybody's talking about. I don't know that it's a 2026 issue, but it ultimately will be an issue, and that's the impact of AI on employment.
You think so?
Yeah. I mean, I've read a lot lately about sort of the questions, and there's no definitive opinion, but it's going to have an impact. It already has somewhat of an impact. I think the economy, market's making record highs as we speak, or it did yesterday, I think. Almost everything I read really expects the market. In fact, several of the economists who I read their outlooks for 2026 think the S&P will set new records. It's between 7,500 and 8,000.
Interesting.
So I think business will be fine.
Good. Okay.
I think it's a really strange year. I think it's a shifting, turbulent year where it's really hard to see clearly, where it's going to go. And I think the result is it kind of gets stuck where it is, which is not a horrible place, right? Things could be better. Things could be a lot worse. The market's doing fairly well. The economy's chugging along and pretty resilient. I think that'll be the case in 2026. I don't think there'll be wild swings up or down, but there's this tension that's kind of holding things in the same place, if that makes any sense at all.
Yeah, no, that's helpful. I like your realistic but kind of a hopeful, optimistic outlook on that. That's helpful because again, it's very confusing and it's hard to predict, but summarizing it that way is useful. So how do you look at the current market thinking about like supply side, demand side, thinking about the actual real estate market heading into 2026? What does that look like for you?
It looks a lot like the economy. I mean, it really does. And it's, I'm not trying to be funny, but it is very similar, Brandon, in that there are different forces pulling in different directions. We've talked about the bottoming process, and we are in a bottoming process. And I think there are lots of points of confirmation of that. At the same time, I would tell you that the bottoming process feels right now like it's choppier than it was and may extend a little longer before we see sort of a prolonged lift in the market. And I think it's tied to some of the uncertainty in the economy.
Yeah.
And it's very market-driven, specific market-driven. We're coming out of absorbing the oversupply that was built, coming out of COVID. That oversupply is being absorbed. Some markets are further along in that process than others. But overall, I think it's going to be I think it's a solid year. I remind people all the time, we're developing. The projects that we're working on now don't have to reach their optimal value tomorrow. We've got time, and I think we'll be well through the bottoming process and coming up the other side before we're ready to sell assets. So it doesn't concern me. I just think the market's a little bit choppier. At the same time, the capital has come off the sidelines. We have not sold a property since 2022, which is kind of when the market got overbuilt and things got softer and rates got softer. And we've not sold a single property in our portfolio since 2022. I've had 4 closings from the middle of November to today. Deals that we started negotiating in late September, October, and they actually closed on the sale of 4 different properties in the last. And we've got other conversations going on. And so what's happening is that the institutional, sophisticated buyers see the bottom and know this is a time to start deploying capital again. They've had their hands in their pockets for 3 years. And not totally, but at some level. And they're getting very active again, which I think is confirmation that we are, in that bottoming process. I just think it may look like a square, a bucket, and not a V. It's not touch the bottom and go straight up. I think it kind of travels along, on a horizontal axis for a little while the market sorts out a few more things. But overall, from a development standpoint, new development as a percentage of current inventory is down under 2.7% on a nationwide average now. It peaked at close to 4% of current inventory in 22, 23. And everything I'm reading tells me that it will continue to decline and ultimately reach about 1.5% of current inventory by 2028, 2029. And there are 2 reasons for that. Number one, there are a lot of headwinds for development today. Fortunately, we're strong enough financially. They don't keep us from moving forward. And we think that's the smart thing to do. Is the premise behind both our funds, which is, development is shrinking, the amount of development. That creates an opportunity in 2027, 28, 29, when there's not as much new supply and demand continues to grow, it'll increase the value of our properties. But there are headwinds, and that has slowed development. The other thing is the storage industry is maturing. And I don't think you'll see the wild swings in the development and the overdevelopment that you've seen historically. I think as a mature industry, 1.5% of current inventory is about where it should be. And I think if developers are prudent, they'll look at the individual market, they'll look at the overall picture, and when we start to creep, once we start to creep above that number, they'll be more hesitant to develop. So I think we'll see it continue down and stabilize in 28, 29 at about 1.5% of kilogram inventory, which is good news. It creates opportunity for us. The regional markets are very uneven. As I said a minute ago, the recovery is very uneven. You've got areas that were so grossly oversupplied that they really haven't completely absorbed what happened. And in some cases, people have continued to build, which has only made it worse. One of the reasons we've been Texas-centric for so long is that these swings in the supply side of the equation don't have as much impact in markets that are growing at dramatic rates. And nobody in the country over the last 20 years has grown faster than Texas, than the Austin metro, than the San Antonio metro, the Houston metro, the Dallas-Fort Worth metro. Nobody can touch their growth numbers. So even though you see oversupply, it gets absorbed faster because of the inward migration into those markets. And so
I will say, as a resident of Fort Worth, Texas, that it is growing very, very quickly. Yeah. Very, very quickly.
I mean, Austin got overbuilt. San Antonio got overbuilt. We've got projects, and I don't think I've been secretive about this. We felt the impact of that with projects that we developed and put on the ground in 2022 that have been slower to lease up than normal. But we're seeing that turn, and we think those markets continue to be really good places. The worst oversupplied markets are the major coastal metropolitan areas, Phoenix and Denver. The Texas metros, Charlotte, Nashville, Charleston, South Carolina, are all markets that where the growth is so significant that, yes, it gets oversupplied in moments, but that really it really absorbs fairly quickly. The secondary and tertiary markets, you have to be careful because you don't have growth, the same kind of growth in those markets, but are still solid plays. And it's really where our strategy hits, because we build in secondary markets, not tertiary, but secondary markets that are directly tied to fast-growing metros like Austin. When I say we develop in Austin, we're not in the city limits of Austin, or very rarely. We're in Georgetown, Texas, Dripping Springs, Hutto, Texas. We're in all the small communities that surround Austin that are supported by Austin. So they're benefiting from the growth in the market, but you don't have the complication of the jurisdictions to deal with like you do in the major metros, that kind of thing. Anyway, and so we're looking for markets that have population growth that exceeds 2.5–3% a year. And with that kind of growth, you can weather the storms. Occupancy across the industry has remained pretty stable. We did see it tick down in Q3, about 40 basis points on average. A lot of that is seasonal. People may not realize it, but the storage business is somewhat seasonal. We see, a lot of lease-up activity in the March through August, September timeframe. The fourth quarter is generally slower, and the first quarter of the year is dramatically slower. January, February, March, and so particularly January, February. So I think some of the drop, but occupancy is still above 90% on average across the country. And the rate pressure has begun to abate. Those two are tied to each other, right? What the REITs did when everything got overbuilt is they drove prices down to maintain occupancy. And so they were successful. They kept occupancy well above 90%, but they drove street rates down for 28 months in a row. We're about at net neutral in terms of rate growth. Some markets are showing positive rent growth month over month. Others are still slightly negative or at zero. And on the whole, we've achieved equilibrium, if you will, between supply and demand, where rates are stable. They're not increasing dramatically, but they're not declining further. And I think that's one of the things that ties back to my comment about what kind of year 2026 will be. If you'd asked me 6 months ago, it felt like we'd see pretty strong rent growth in 2026. I don't think that's going to be the case. I think we'll see rent growth, but I think it'll be, that 1, 2, 3% range, not something more dramatic than that. And I think that's where the recovery kind of gets extended out a little bit.
Okay.
Cap rates in the market have ticked down. We're seeing deals go off at a 5.5 to 5.75 cap rates, which is a tick down from where we were at around 6, maybe slightly above or below 6. And I think there will be continued slight compression in cap rates for self-storage because the Fed fund rates are going to come down, and that means overall investment returns and expectations will come down, and people will be willing to accept slightly lower yields. And I also think you're going to see a bit of a feeding frenzy here with the institutional guys trying to find, good properties to acquire. We're already, like I've already told you, we're seeing that today. So those are the sort of the major components of the market today. And all in all, it's a positive picture. It just has a lot of noise in it in terms of a direction from here. And I want to remind everybody, because we talk about this a lot, it's why we believe development is such a critical play to have in your portfolio. Because we're more insulated. Yes, we can be impacted. Yes, the lease up of a facility can be slower than we projected. We're not seeing significant changes in construction costs. So really the risk is the lease up risk. And that's never a good thing if you're a little slower leasing up. But because of the built-in value, the difference between what it costs us to build a facility and what the cash flow stream is worth once we establish it, we've got more room to absorb a body blow, a market that's a little slower than we thought, than acquiring existing properties. And that's why we've stuck to our strategy to continue to develop. And Fund 1 is doing great. Our lease up in the Fund 1 properties is doing really well. And we're super excited. In fact, Brandon, we just took down the first piece of land in Fund 2 today. And we'll start construction on a site in Houston. I don't think, because of the holidays, we could get started before Christmas, but I think we're probably going to push it to January 1st just because of the holidays and everything.
Yeah. Congrats. That's exciting. That's an exciting milestone for Growth Fund 2. That's
for Fund 2,
that's great.
Continuing to raise capital there, obviously, but it has broken escrow, and so it can now start making investments. And the Huffmeister project in Houston's one we're really excited about. So
very cool. Yeah. Okay. Well, I want to recap. That was a lot of information all at once. So to recap, current market conditions, overall hopeful. You're seeing this bottoming process, but you can see we're kind of on our way, maybe through that and out of that. And you're seeing that in the construction pipeline and how that's impacting your kind of forecasting there. You've got uneven recovery based on different regions. So you're seeing a balanced market in some of the Texas metros. There's oversupplied markets in major coastal metro areas, possibly undersupplied markets in secondary cities. You're looking at occupancy trends that is around 92%. And then you're seeing a slight growth in the rental rate for 2026. Is that a fair summary for all those little points? Okay, great. So if we wanted to carry this forward, we could go into talking more about market fundamentals, or we could talk about some of the investment opportunities that you guys are seeing in 2026.
The fundamentals is an easy one. I think there's some interesting things happening in the fundamentals. The underlying fundamental that we talk about a lot is household formation, and continue to run at between 1.3 and 1.5 million households that are formed on an annual basis. We are seeing the millennials and the older Gen X, not the younger end of the Gen X generation, but the older Gen Xers are now in their mid-20s, 25 to 28, and they're entering the peak household formation age. At the same time, the boomer generation is going the other way, and the combination, household formation, starting a family, creates all the life events that require storage.
Yes.
And so on the other end, you've got the boomer generation like me. Kids are gone. We're downsizing. We're keeping all this stuff that we think the kids want one day, but they really won't. But we're renting storage facilities to keep
get rid of
it. So those trends are intact and solid. And if you look at the demographic breakout across the country, the millennials and the Gen Xers are the two largest generations in that socio-demographic mix. So you've also got a population that remains fairly mobile, which is another key driver for self-storage. But there are a couple things that I think I mentioned on an episode, weeks or months ago, but we're starting to see more and more of. Everybody's talking today about affordability. The politicians are all talking about affordability. One of the things that's happened in the new home market is that in order to make homes more affordable, they're building smaller homes. Now, not everywhere. Obviously, they're still building large homes. But
I'm tracking.
On average, what you're losing is storage space. The rooms are getting smaller. You're getting less storage space. And then you've got a whole generation and a half that either haven't been able to afford a home or their lifestyle is so mobile they don't want to own a home. And those millennials and Gen Xs are using self-storage like their garage. It's where they put all their toys, their bikes, their motorcycle, their four-wheeler, their skis, the stuff they don't have room for in the apartment, or they bought a house that doesn't have room for it. And so we're seeing a whole new may be a little bit dramatic, but a whole, it's not like it never happened before, but it's a growing trend. And these people are a little bit heavier users. They're in and out of the storage facility more frequently than, the guy that's having his kitchen remodeled, and so he put all his kitchen furniture in storage, and it stays there for 6 months. He comes back 6 months later and gets it. But there is a lifestyle trend that really, between the smaller living spaces and younger generations that are more apartment oriented and don't have storage space, storing their toys, and that combined with the aging process for that generation, household formation, and the boomers going the other way, keeps demand at very stable levels. I mean, I think demand will continue to grow, and I don't think there's anybody in or outside the industry that thinks it otherwise. So we feel pretty good about that. In the last 4 years, the market's demonstrated the resilience that we talk about all the time. It hasn't been a great market since we came out of COVID. Got overbuilt, rates down, we've talked about all that. But the reality is we've seen deals hold up. The default rate in self-storage is still the lowest of any sector in the real estate industry. And assets continue to perform. Maybe not at the level they did in a different cycle, but they still are providing positive returns. And here's the equation. Economic slowdown equals lower mortgage rates equals increased home sales and therefore increased storage demand. It's a little bit oversimplified, but that's one of the reasons that's counter-cyclical, that self-storage tends to outperform other types of real estate in a down economy, because rates come down, houses become more affordable, people move more, and people become more mobile, because if they lost their job in New York, they've always wanted to live in Florida. It's a great time to sell your house and move to Florida, right? And get another job, but get one down there. So people become a little bit more mobile, and that drives the usage of storage in down economies. A lot of what's happened in storage in the last 4 years has been self-inflicted. Just overbuilding, people being a little bit reckless, and but it's, as we've said, it's really correcting itself.
So I like how you mentioned that lifestyle narrative, because I think it's maybe hard to, it's very conceptual, might be abstract right now, but I'm curious how my generation, so I'm 35, I have little kids, forming households, buying all the things. I have too many toys. I got to shove them somewhere. But then also the boomer, parents are passing down their stuff, like you're saying. So what do we do with all this stuff? And because of COVID, because of our generation, my generation, millennials, we're having this interesting conversation about what is my relationship to stuff? What do I want to buy? What makes me happy? What is my value? Or what do I seek value in other things? Do I want to move out to a smaller city that's a little quieter, more peaceful, less things, smaller house? Like, how does all that? I don't know. I don't know where to go with that, but I am seeing friends talking about that. We're talking about that as a couple, and I'm reading a bunch of articles that I've seen just in the past couple of weeks from the Wall Street Journal, the New Yorker, talking about the passing down of stuff from generation to now the millennials, and just all the complications that come with that. So anyway, it's kind of an interesting point to think about with the hard economic data as well.
Yeah, it's the underlying fundamental thing that drives demand in the market is stuff. And I don't see Americans falling out of love with stuff anytime soon.
Okay, all right, okay.
And your generation is all about the toys.
There's a lot.
You'll buy cheap furniture at IKEA so you can buy a motorcycle to ride on the weekends.
Yes. Or in my case, like an iPad or something, But yeah, no, totally. Yeah, no, it's true. But it's definitely something to think about for sure. I know my generation's thinking a lot about it. Okay, so as we wrap here, any closing thoughts, final thoughts?
Yeah, two or three quick things.
Yeah.
Because we are running long on time, and I know we probably need to wrap it up. But we were going to talk a little bit about opportunities. We've already touched on this, but I would just highlight that we believe the best opportunities in the market today are undersupplied or stabilizing secondary and tertiary markets, including the city skirt markets. In fact, I would put them first on that list, the city skirt markets that are supported by growing, vibrant, major metropolitan areas. And that is our strategy. We build in the city skirt markets that are connected to, we're building in Fund 2 as a project in Gastonia, North Carolina, which is 16 miles west of the center downtown Charlotte. All the things we're doing in Austin and San Antonio and Houston are in communities that, are bedroom communities to those major metropolitan areas.
Yeah.
So I thought about this in preparation for today. I'm just going to give you my opinion. Right now, if I had the choice to invest in existing properties or develop, I would be a little more cautious on the existing side than I would be on the development side.
Okay.
Because of the uncertainty of where we are in the bottoming process. I think from a development standpoint, when you've got a deal that's not going to deliver to the market for 6 months to a year, and you're going to build it in phases, a project, the Huffmeister project for Growth Fund 2, will complete by mid-year 2026, and it will be in lease up of phase 1 till at least mid-year of 2027. 12 months is what we shoot for. 18, we give it 18 in our projections, but we try to get it done in 12. And then we'll build phase 2 and lease the whole project up. But you're talking about a project where the market dynamics are really going to matter in 27 and 28, not 26. And I think we're well out of the bottoming process by the time we get there. Just a little thought for people. And the other thing, I thought it would be fun. I tried to come up with a headline. And by the way, we haven't talked about small bay industrial at all, which is the other product we build.
Yeah, go for it. We got time.
And I can do that in 3 phrases. Tight supply, durable demand, constrained development. It continues to be one of the, if not the hottest sector in all of real estate. And occupancy nationwide's over 97%. And we're seeing our projects pre-lease to 60 and 70% occupancy before we even get a CO, which in that type of real estate hasn't been the norm in the past. It's really the norm in retail and office where you can't even build a project till you have it 50% leased. But we more often than not build the buildings and then start the leasing process. But the market's been so hot, we've been able to pre-lease them. But for self-storage, I would say the 2026 headline is rising demand, strategic growth, and investor opportunities in a shifting market. Because I still think the market feels like it's moving around a little bit and hasn't totally found its legs. In the small bay market, again, high demand, tight supply, and strong investor returns would be the headline for 2026 for small bay industrial. So,
I love it. I love it. You've talked a little bit about the small bay industrial and the reason it's so hot in a couple of other episodes, and so it's encouraging to hear that trend is continuing into next year. And I know it's part of your thesis. It's why you guys are so passionate about what you're doing. But it sounds really positive in a lot of different ways. Uncertain, but generally in the right direction, which is exciting.
Yeah, it's not uncertain in a negative way, like, oh, we have no idea where this market's going.
Yeah,
there's
right.
lots of risk. It really is.
Yeah.
It just doesn't feel, the ground's still a little squishy.
We
were sinking up to our knees 24 months ago.
Yeah.
That's no longer happening.
Cool.
But the ground still doesn't feel totally firm in terms of the direction. More the speed than the direction. The direction is determined. It's really the speed at which it moves in that more positive direction as it comes out of the cycle that is a little bit harder to predict. Maybe that's a better way to say it than I've said it in the 30 minutes we spent talking about it.
No, I like that. Yeah, I like that. Awesome. Okay. Well, this is great. Thank you. Any final thoughts or anything you want to leave listeners with? That's
been fun as always.
Awesome. Paul, thank you so much for your insight. I know you put a lot of research into this and thinking through this. And again, we have a research report on our website, AAAStorageInvestments.com/insights. You'll see it there in the middle of the page. But this is really, really helpful. And I hope it serves investors well. The way that you guys are thinking about it, because your investment decisions, your development decisions, these are all predicated on this data and on this research. And it's stuff that ask the team, ask Paul, ask Andrew, ask the team about where they're getting these numbers and back that up. And so I know that you guys do that really well, and I'm very grateful that you do that because it serves us very well.
Well, we love what we do, and we love providing great returns to our investors. But and generally, it's what drives us. At the same time, I don't think you can ever forget that we're the largest investor in Fund 1 and Fund 2, and so we're doing for our partners what we would do for ourselves in terms of trying to get the best feel for the market and make the best decisions that we can. So
that's right. Having that skin in the game makes your due diligence all that sharper. I appreciate that about you guys.
I would hope we do it the same way if we didn't, but
sure.
But
we're human beings.
Human nature is human nature. So who knows what the answer to that question is? But
that's right.
But we try. Nobody can predict it perfectly. I'm not here to give investment advice, or I don't have a crystal ball. But we feel good about where the market is. I will look forward to the next part of this cycle speeding up as we go deeper into 2026. I think 2027 and 2028 are going to be super interesting years in a positive way.
Yeah.
And we just got to keep going.
Yeah, I like that. Well, Paul, thank you as always. It's good to see you after a nice Thanksgiving, and we'll see you very soon.